the first day of the week. We're doing the rags to riches. So last Friday, I called out the new members for this new cycle. We're going to take a new approach to rags to riches, but we're going to use the same old engine. So today I reset my account again. I keep getting a bunch of DMs asking me when I'm going to do it again. People want to keep up with it and they want to follow along and all that. So today's the day. So I reset it. Let me pull up my screen so you guys can see the engine. I'll very briefly walk through this. Dig into what each of the parts means, and then I'll show you how I did it in practice, because nothing matters until you can actually do it. So step one of the engine, of course, is financial security outside the market. We want a clean, visible budget. We want to reduce recurring expenses. We want to build our credit score. Even if you don't feel like you need to borrow, that'll come back and bite you in the end when we go to take out a securities-backed line of credit when you've got a massive portfolio and no credit. So definitely important to maintain, and there is a plethora of advantages to having a good credit score. Once we're in that position, we can make consistent contributions. So on this account, I'll be making a $500 monthly contribution. It just seems like that's the amount that most members tend to resonate with, because it's not an obnoxiously large number, so it is still achievable for many. But it's not, it's not so small that people can't follow along. So I just kind of reach that middle ground there. So just to demonstrate growth over time, as well as making it accessible enough so people can understand it and see the difference over time. And that is one form of revenue into a portfolio. So it's a glorified piggy bank at that point. But I want to control that interest rate. I want to turn it into a savings account where I control things. So as soon as the money goes in, I diversify it. I split it up into investment allocations and speculation allocations. So about 70% of the monthly contributions will go into investments and long-term passive compounding growth. 30% will be my kind of fun money, speculative amount. That's what I'm going to use to really speed things up early on, especially. So let me just come over to Webull really quick, and I'll just kind of show you guys what it looks like in practice. So here's Webull small cash account. We started at 1,000. I actually trimmed it down to $9.99, but that's because I'm really bad at math and I was off by $1. So it was supposed to be $1,000. So today's profits are actually $25.63, not $24.63, but that's completely negligible. But the main point is I just made 2.5% today on the premium live stream. Everybody watched me do it. We traded, what was it? It was MEHA. So I kind of walked through all the little technical analysis strategies that we use. I walked through all of that. It was all fun and great and good. But that's not what this episode is for. This episode is to walk through this engine and then show you kind of how I do the things I do and why I do them. So on the investment side, this is kind of where I focus today. Since I had $1,000 in the portfolio, I decided to split that into $700 and $300. So $300 was for speculation, $700 is for the investment side. So I'm primarily dealing with dividend positions at this point. I have a lot of ETFs. I have a couple private companies. You can also incorporate things like REITs and things like that. I got a couple dividend aristocrats like O and Maine. They're just stable dividend paying positions that I love and I will die with, because they just keep raising their dividends. They're not glorious, but they work. I also have a unique strategy, unique to retail traders anyway, in that I also take on yield max or high yield, high risk ETFs, which are designed to fail. Those shares are designed to lose money, and I'll explain why those are important in a moment. But just understand that the dividend payout is a taxable event. I do receive money, and my goal is to immediately reinvest that money into more dividend positions. I want as many of these shares as possible as early as I can within a ratio. I want to keep them balanced. I don't want things to get out of whack. Because the faster I start this ball rolling, the faster the compounding effect kicks in and things go parabolic. So that's how you grow wealth. So with that said, on the speculative side, I am also just taking 3 $100 trades per day because I have $300. If a position is higher risk, I might take a $50 trade and maybe take 2 of those. Today, I could have stopped trading after my first trade. I hit my $10. We had the target right then and there. That would have been my 1% for the day. My goal is to reach 1 to 3% per day without taking huge risks, just to show people that consistency pays. Obviously, you guys have seen me trick out these small accounts, but it's fun to watch, but it's not useful. So I'd rather just give these predefined outcomes. If I take 5 trades, for example, with $20 each, and I seek 1% loss max and 2% minimum profit, I will have a net outcome between $2 and negative $1. The goal here isn't the specific dollar amounts, it's the finite array of potential outcomes, and that they fall into 2 buckets: reinvestment for profits and tax advantages for losses. So the way that the general oversimplification for taxes is basically money that I make, I have to pay taxes on at a lower rate than what I'm allowed to deduct as a loss. So if I make $1,000 over the course of a year, I have to generally pay $300 to $350 because I owe the government 30 to 35%. Roughly speaking, it's going to depend on a lot of factors because they're short-term capital gains, meaning that they're just money I made on stuff that I traded short-term or within the year. If I hold something longer than a year, then it's maybe 10%. So it's a lower rate if I hold it longer. Dividends operate a little bit differently, and there are also companies which file K1s, for example, which operates even more differently. So there's a lot of nuance, a lot of things to learn, but you don't have to master it all to get the basic concepts down. So, and that's for profits. Anything that I take in the form of a loss, as long as it's not excluded because I don't trade it too much too rapidly, in the form of a wash sale, which is it disallows the loss, so I can't use it for a period of time. But losses are generally deductible up to 100% of the amount of the loss. So it's a lot like, I hate to use the analogy, but it's a lot like corn. It's not goodbye, it's see you later. So if I have $1,000 in profits, I pay $300 to $350 in taxes, right? And then I'm also allowed to use my losses for the year in that same amount against the $1,000 that I made to reduce the taxable income. Now, the advantage here is that since I'm making this money and immediately reinvesting it, I don't have to give those shares back to the government. I still made the money and I still owe the taxes, but I can take losses against those dollars that I've made, and I can deduct them so that I have to pay less and less in taxes. The goal is zero, obviously. But I still have those shares and they're still reinvesting and they're compounding, and that's the magic. So that's what this series focuses on specifically. And then, of course, the speculative amount, that's just, a fuel to the fire. And this will absolutely outperform these dividend payments because these are, anywhere from weekly frequency up to quarterly. So they're very slow, very small payments. But once that ball starts to roll, it's a beautiful thing. So with that in mind, let's switch over to the actual portfolio so you guys can kind of see how I did it. I made a little spreadsheet just to help make it a little bit more visually appealing. So I've got two weekly dividend payers, and this just means that TSLY and IWMY, they pay me every single week. It's not huge amounts of money, but it is high frequency, which is kind of a double-edged sword. So these are high yield, which means that if it's a 10-cent dividend payment that week, the share value will be reduced by that amount because that's how dividends work. It gets trimmed off of the share value, converted into a cash payment, and then I reinvest those cash payments into more shares elsewhere. I don't want to reinvest them into high yield stuff because those new shares are just going to keep losing value as well. So they use a synthetic covered call strategy, which is designed to lose money over time, and it just can't outperform those super frequent adjustments. So these shares are meant to be sold for a loss at the end of the year in a smaller quantity so that I don't have to pay so much in taxes, right? That's the name of the game. And then once you get this massive portfolio, 7 or 8 figures, then you can take it out, a securities-backed line of credit or something like that. That's the more of the long-term wealth management strategy. And in that case, you're really just paying a 3% interest rate or a 5% interest rate to a specialized lender like Morgan Stanley, instead of paying 30 to 35% on that same large number, or 6 figures worth of dividends, if that's the case. I'd much rather pay that 3%. So from start to finish, the whole advantage and the main purpose here financially is just to reduce the amount that you pay needlessly. You don't pay more for your phone bill, right? Because you're not going to get more phone out of it. Everything's unlimited nowadays. So why would I pay the government, the IRS, more than I have to if I'm not going to get any more government out of it? I'm not going to get more representation, more freedoms, or anything like that. So I want to pay as little as possible. No offense, Uncle Sam, if you're watching this, but I want to keep my money as much as I can so that it can compound early and fast. So I've got 2 weekly payers. These are high yield, so they're going to probably make more dividend income over the same amount of time as something like Pfizer, right? Because this pays me once per 3 months. So it's very, very, it's like a 12-to-1 ratio here. I get 12 Tesla payments for every 1 Pfizer payment, and it's a higher percentage yield. So the shares will lose value. The dividend income will come in much faster, much more aggressively, and then I can reinvest those into the more stable investments like Pfizer, Schwab, ET, Maine, and O, right? Then on the monthly side, I've also got O and Maine. These are the dividend aristocrats. They've just been very, very stable, very steady. These are staple positions in, I think, any portfolio account. You've got the VOO, the Vanguard ETF, you've got O, you've got Maine, and then you've got the Schwab suite. So in this case, these are my 2 monthly pairs. And the reason I want to do weekly, monthly, quarterly is to smooth out the payments as well. So I don't have to wait 3 months for these reinvestments to show up. All right. Then I've got my 3 quarterly. These are the more stable ones. These are the ones I want to invest in longer term. This is Schwab ETF. It pays me every 3 months. ET, Energy Transfer, and Pfizer. It's a private company, you know. So I always like to have at least 1 or 2 in there. I discussed this one versus Johnson & Johnson earlier. I am always going to be a diehard fan for Johnson & Johnson and Pfizer, but Pfizer is more appropriate for the size of account because of the allocation amount that I'm dedicating to each of these positions. So in the future, I may rotate this out for Johnson & Johnson or vice versa. I'm just going to play that by ear and see which company gives the better opportunities. So basically, I just committed $100 7 times. So my contribution amount was $700 because I've got $700 for investments, $300 for speculation. So I committed a flat rate for each of these across 7 positions, $100 each. I haven't gotten any dividend income yet because I bought these less than 8 hours ago. And these 2 will kick in. These 2 top ones will kick in every week. And I'll just update these columns as an aggregate count. So next week I'll get paid for, or this week I'll get paid for Tesla. It'll be like 30 cents or something probably. And then next week I'll get maybe another 30 cents and I'll just add those 30 cents together and it'll just be a total count that I've gotten over the lifetime since May 11th. Today's May 11th. Also happy Mother's Day. And then I'll do that for all these positions. I'll keep track of all that stuff. I'll put it in here and that will show up here under dividend surplus. And then that is going to, let's say I get $5 in dividends. It'll increase my allocation amount for these long-term positions by that amount so that I don't have to keep track of the number of individual dollars I have in the portfolio and try to figure out how much I'm putting into the speculative stuff. On the speculative side, I will be trimming these profits. Okay, and let me just draw this out really, really quickly. Let me just see if I can grab just a blank slate here. Oop, I guess we're going this way. All right. Let me just grab my drawing tool really quick. I don't want to make this video super long. I just want to kind of walk through how I do this. All right, so let's grab a red tool. I'm just going to draw a bunch of lines, and then I'll kind of walk you through how I do this in case I didn't do it on my last video. So this is kind of my speculative growth management strategy, whatever you want to call it. And then I've kind of got this big pool where all these profits are going to go into. So basically, the idea is very straightforward. Let's say I've got 300 now. Okay, I'm going to grow that 300 up to 500, and that's in parallel with the 700 plus whatever the investment side gives me. So I want to grow the 300 up 60% or 66%, up to 500. That'd be, yeah. And then basically I want to take that number and bring it up to a ceiling that is well below my tolerance because obviously I have a lot higher risk tolerance, but I just want to trim from 500 back down to $300. Okay. And I just want to do that a couple times. And the reason for that is multifactorial, right? So if I can do this consistently, let's assume I'm a new trader, and I'm kind of doing this all for demonstration. That'll help me identify where my specific risk tolerance threshold is. So if I struggle at $500, I know that I need to spend some time around $500 so my brain can get used to seeing that number. So what I do is I take the 300, I bring it up to 500, and then I trim 200 out. And then I do it again. And I say, okay, I'm at $500 again. Let's trim the account. And we take that $200, we set it aside. Then we do it again. And then we set it aside. And then instead of going and trimming it again at 500, maybe I'll bring it up to 700 or 750 or something like that. That's another 200. I'll trim that again and I'll bring the floor down to 500, which was my previous ceiling. So I'm just kind of exploring my own personal support and resistance zones, which is a wonderful exercise for new traders. And then every time I'm trimming these dollars, right, that's $200 a pop times 6, that's $1,200. And I haven't needed to add any more money, and it's deceptively fast. 200, 200, 200, or 600 times 2 is 1,200. I started all this with $300. So I've 4x'd my amount of speculative allocation right there. And this all goes over into the investment side, which already had 700 in it, which means I've got $1,900 now to get those dividends rolling in, which is, almost 3 times what I currently have in there on day one. So there's a huge advantage in doing it this way and just having a system in place. And then from here, we can increase it proportionally. Maybe I go from 700 to 1,000, right? And I do that 3 times. That's $300 a pop. That's $900, right? And then from here, maybe I go up to 1,500. right? That's $500 a pop. 1, 2, 3, right? 1, 2, 3. That's $1,500. I don't know why I draw my stuff out of order here. So at this point, if I, let me just erase this 1900 because I want it to be accurate. I've harvested 1200 from these two tiers, then another 900, then another 1500. So that's 24, 3600 plus 700. That's $4,300, right? Starting with $300 speculative and $700 for the investment side. And that is plenty of money to get these income dividends just rolling and rolling and rolling and reinvesting and reinvesting. And it really doesn't take that long to bring $300 up to $500 if you compound 1 to 3% on a very frequent, very consistent basis. The only thing that gets in the way is the big losses, and we know to cut those out sooner rather than later, not living in denial and not taking unnecessary, unhealthy risks. Okay? So that's the plan. That's the engine. That's what I've been doing for the last decade and a half. And that's what I've been teaching my students. So if you're paying attention to this, you guys are in on the ground floor. Again, I'm resetting this account. I've got 10 students now. We're going to get them set up this week. We're going to start doing the spreadsheet stuff. We're going to walk through the basics of the market, how all this works, and then we're going to dive into the passive income side of things so that we can build that foundation and get the floor to rise higher and higher every month or every week if you're breaking it up like I am. So that's the gist. I'm going to end this video here. It's about 16, almost 17 minutes. Thank you all for watching. I'm going to try to post these more frequently with updates to the account. So right now, very, very basic stuff. I only have $1,024.48 in the portfolio. That's 95-cent open P&L. That's the reflected balance after these positions here. These are the 7 investment stocks or the passive dividend ETFs. This does not include the $324 now in settled cash for tomorrow's speculative trading. So tomorrow morning, I'm going live at market open, and I hope to see you there. Enjoy.